Whole life insurance has long been portrayed as a comprehensive financial product, offering lifelong coverage and a cash value component that can serve as a savings or investment tool. However, behind this glossy facade lie hidden costs and deceptive selling points that can significantly impact the value of your policy. Today, we're going to dive into the world of hidden fees and the strategies used to market whole life insurance, shedding light on the reality behind the alluring sales pitches. First, let's understand the appeal of whole life insurance. Whole life insurance is often marketed as the ultimate solution for financial security. It promises both death benefit coverage and the opportunity to accumulate savings or cash value. This dual purpose approach can make whole life insurance seem like an attractive choice for individuals looking to protect their family's future while building a financial safety net. But there are some deceptive selling points I want to cover today. First, the forced savings that you hear about. One of the most common deceptive selling points is the idea that whole life insurance serves as a form of forced savings. Agents will argue that it compels policyholders to save by locking away a portion of their income in the policy. While it is true that whole life policies include a cash value component, the high cost associated with these policies often results in par returns, making them an inefficient savings vehicle. The second deceptive selling point is the tax benefits. Some agents emphasize the tax advantages of whole life insurance, such as the potential for tax-free withdrawals. While there are tax benefits, they often don't outweigh the high premiums and fees associated with these policies. Third deceptive line used is lifetime coverage. The promise of a lifelong coverage is a powerful selling point. Agents assert that whole life insurance ensures that you'll have protection throughout your entire life. However, this security comes at a significant cost, making whole life insurance prohibitively expensive for many individuals. The fourth deceptive tool used is dividends. Whole life policies are sometimes marketed as a vehicle that pay dividends to policyholders. While this is true for some policies, the dividends are not guaranteed, and the return on investment is typically lower than what could be achieved through other investment options. Another thing you need to look at is the impact of hidden costs. The presence of hidden fees in whole life insurance policies can have several detrimental effects on your financial well-being. While these effects have been mentioned before, it's essential to reiterate their significance. 1. Reduced cash value. The fees can significantly diminish the cash value component, making it less effective as a savings or investment tool. 2. Limited flexibility. The high premiums and fees can limit your financial flexibility, making it challenging to allocate your resources to other important financial goals. The third hidden fee is lower returns. The fees associated with the investment component of whole life insurance can result in lower returns on your cash value. And the fourth hidden fee is the reduced death benefit. If the cash value is depleted due to fees, it can affect the overall death benefit your beneficiaries receive. So let's look at the selling strategies and their impact. Deceptive selling points coupled with aggressive sales strategies can lead individuals into purchasing whole life insurance policies without fully understanding the financial implications. Agents often push the emotional aspect of protection and promise guaranteed returns, glossing over the high cost and the limitations of these policies. The outcome of buying term life and investing the premium difference. Let's take a look at that. An alternative to whole life insurance is to purchase term life insurance and invest the premium difference wisely. For instance, if you were considering a whole life policy with a high premium, you could opt for a term life policy that provides the necessary death benefit coverage. The premium difference between term and whole life insurance can then be invested in a vehicle such as an S&P 500 index fund, which has historically shown strong long-term returns. By choosing this approach, you can achieve several advantages. 1. Lower cost. Term life insurance premiums are significantly more affordable than whole life insurance premiums for the same coverage amount. 2. Investment potential. By investing the premium difference in an S&P 500 index fund, you have the opportunity to benefit from the stock market's historical growth. 3. Liquidity. Unlike the cash value in whole life insurance, investments in an S&P 500 index fund are highly liquid. You can access your funds when needed for various financial goals. Flexibility. You have control over how you invest and manage your funds, allowing you to adjust your investment strategy as your financial situation evolves. 5. Greater returns. Historically, the S&P 500 has shown impressive returns over the long term, which can potentially outperform the returns offered by the cash value component of whole life insurance. Whole life insurance can be a legitimate choice for certain individuals with specific financial needs. However, the hidden costs combined with deceptive selling points can make these policies less advantageous for many. Before investing in whole life insurance policy, it's essential to carefully review the terms and understand the impact of fees on the policy's performance. It's crucial to approach life insurance decisions with a clear understanding of your financial goals. Seek the guidance of a financial advisor who can provide you with unbiased recommendations and help explore alternative options. Just think about it. Life insurance. The purpose of life insurance is to replace your income in the case of a tragedy of your death. It's not an investment tool. Whole life insurance is combining insurance and investing. And the only one who truly makes out are the agent and the company, because they are keeping fees and commissions out of your investment. One of the big things you'll hear often is, well, term life typically doesn't pay out. If I get a 30-year policy when I'm 35 to protect my family in case of the tragic death and loss of my income, it'll pay out if I die in those 30 years. But when I'm 65 and I haven't died and the policy goes away, I haven't invested that much in the term life policy. But now, hopefully, because I've invested the difference of those premiums from whole life, I have a nice portfolio full to live on and to pass on. So with a 30-year policy at 65, if I still haven't passed away, I lose the policy. It doesn't pay out. And it served its purpose. It protected my family during my working years. But now that I'm retired and I have my own income, self-insured, I don't need to replace that if something was to happen to me. Meanwhile, the difference in the premium that I save buying term life, I can invest in over a 30-year period. That provides an even greater nest egg that I can utilize to live in retirement or to save and continue to grow until I do pass, and then pass that on to my children or my grandchildren. Whole life is not meant to be strictly an insurance policy. The selling point, whole life is used by agents because they are trying to make a commission. Term life is to cover your income loss in the tragedy of your death, to protect your family until you're able to be self-insured. Do the math. I guarantee you the term life works out better by investing the premium difference. Hopefully these deceptive lines and tools that are being used by agents to sell people and hook people into whole life policies give you further information. But remember, informed decision-making can help you secure your family's future without falling victim to the hidden cost and deceptive strategies used in the sale of whole life insurance. Remember, when it comes to life insurance, transparency and well thought out strategy are key to making the best financial decision.